There is a lie on your screen right now. It's sitting right there in the top right corner of your brokerage app. That all-time high on the S&P 500, that isn't a sign of health. That is bait. Because while the retail crowd was busy popping champagne over a 2% rally, a very different transaction was taking place in the fiber optic cables beneath New Jersey. No bells rang, no headlines broke, no price alarms triggered, but the data left a fingerprint. $180 billion. That is the exact amount of liquidity that just vanished from the institutional ledger. BlackRock and Vanguard didn't just trim their positions. They executed a calculated evacuation. They are handing their bags to you, dollar by dollar, trade by trade, keeping the price artificiality stable until the trapdoor swings open. They see the date on the calendar, March 2026, the debt wall, and they are making sure they are the only ones holding cash when the rest of the world is left holding the bill. The heist is already over. You just haven't looked at the surveillance footage yet. Let's look at the patient on the table, the S&P 500. If you only look at the price action, the patient is an Olympic athlete, breaking records, sprinting higher every single day. The media is calling it a new golden age. They are telling you that the recession is canceled and the soft landing is achieved. But take the stethoscope and listen to the heart. There is no pulse. Look at the volume. Volume is the blood of the market. It represents conviction. It represents actual people exchanging actual currency for shares because they believe in the future value of the asset. In 2021, when we hit those previous peaks, the volume was deafening. Everyone was buying. Retail, institutions, hedge funds. It was a stampede. Now look at the chart for January 2026. The price is higher, but the volume has flatlined. It is a ghost town. The divergence is so sharp it looks like a glitch. We are seeing prices drift upward on fumes. It is the financial equivalent of a balloon that has run out of helium, but is being kept aloft by hot air alone. This is what technical analysts call a bearish divergence, but I call it something else. I call it a trap. A market that rises on low volume is not a market that is buying. It is a market that is being painted. Someone is keeping the lights on to make the store look open while they empty the inventory out the back door. And that brings us to the $180 billion question. If the retail crowd isn't buying and the volume on the lit exchange is dead, then who is selling and where are they doing it? The answer lies in the plumbing of Wall Street that you are not allowed to see. The dark pools. These are private exchanges run by major banks where institutional orders are matched anonymously. They were designed to prevent massive trades from moving the market, but now they are being used for something far more sinister. We have tracked a net flow of negative $180 billion over the last 4 weeks. That is not a correction. That is a liquidation. While CNBC is telling you to buy the dip, the people who own the market are selling the rip. They are unloading massive blocks of equity into a market that has no depth. And they are doing it with surgical precision so as not to wake you up. You might ask yourself why. Why would they sell now? We are in the age of artificial intelligence. We are on the brink of a productivity boom that will rival the Industrial Revolution. That is the narrative, right? That is what they tell you in the Super Bowl commercials. But let's look at the men who are actually building this future. Look at Jensen Huang, the CEO of NVIDIA. The man is treated like a rock star. He signs chests. He fills stadiums. But look at his Form 4 filings with the SEC. He has been selling stock almost every single day in January. Look at Mark Zuckerberg. Meta is hitting all-time highs, yet he is cashing out at a pace we haven't seen in a decade. Even Jeff Bezos is accelerating his sales. These are the insiders. These are the people with the God's eye view of the economy. If I was truly about to usher in 1,000 years of prosperity, why are the architects of that future selling their ownership stakes to you in exchange for cash. They are trading the future for the present. That is the paradox. They scream buy into the microphone while their hands are busy hitting the sell button under the table. They are not investing in the long term anymore. They are securing their exits. This is usually the part where a financial advisor tells you to diversify and hold on for the long run. But you didn't click on this video to hear the same advice that lost your parents 30% of their retirement in 2008. You are here because you can smell the smoke even if you can't see the fire yet. This channel is an outpost for the few who want to see the raw data before it gets sanitized for the evening news. If you want to be part of the minority that understands the mechanics of the machine, rather than just being fuel for it, then you should subscribe and stay close. We are going to be tracking every dollar of this exit flow. So we have established the crime scene. We have a market at all-time highs with zero volume support. We have the smartest money in the room exiting the building through the fire escape, while telling you the party is just getting started. But the question remains, why now? Why the rush? Why are they willing to sell their own companies at the very moment of their greatest triumph? They are staring at something on the horizon that isn't on your radar. They are looking at March 2026. They are looking at the debt wall. Trillions of dollars in corporate debt and government treasuries are set to mature. This debt was issued back when interest rates were near zero. It was free money. But when that debt rolls over in March, it has to be refinanced at 5 or 6 or 7%. The math doesn't work. The zombie companies that have been surviving on cheap credit are going to starve. The liquidity that has been sloshing around the system is going to evaporate overnight. BlackRock knows this. Vanguard knows this. They know that when that wall hits the liquidity window, slams shut. They have to get out now, because in 6 months, there won't be enough buyers left in the world to absorb $1 trillion of selling pressure. I am not here to comfort you or tell you that it will all work out. I am here to dissect the trap so you don't get caught in it. If you are looking for reassurance, you are in the wrong place. But if you want to know why your account balance says you are rich, while the actual structure of the market is rotting from the inside out, then you need to pay attention to what comes next. Because you might be wondering how it is even physically possible to sell $180 billion of stock without crashing the price immediately. How do you hide an elephant in a room full of people? You don't just dump it. You slice it. You use an algorithm designed to exploit human psychology and mechanical structure. You use the iceberg to understand how you move $180 billion without crashing the market. You have to stop thinking like a human trader and start thinking like a machine. A human trader sees a stock price and feels fear or greed, but an execution algorithm feels nothing. It has one directive: minimize market impact. If BlackRock were to dump their entire position on the open market at 9:30 a.m., the sheer weight of that supply would shatter the order book. There would be no buyers at the current price. The bid stack would evaporate. The price would free fall from $500 to $300 in seconds, triggering a flash crash that would halt the exchange. That is what they call slippage. And for a fund the size of BlackRock, slippage costs billions. So they do not dump. They distribute. They use what we call Iceberg Orders. Imagine a massive block of ice floating in the ocean. You are standing on the deck of a ship, looking out at the water. You see small chunks of ice breaking the surface. 100 shares here, 200 shares there. These are the trades you see on your retail brokerage app. These are the trades that paint the ticker tape green. But beneath the surface, connected to those tiny visible chunks, is a mountain of mass that you cannot see. The algorithm takes that $180 billion exit order and slices it into 10,000 micro orders. It uses a strategy called VWAP, or Volume Weighted Average Price. The machine watches the volume of buyers coming into the market. When you and the retail herd rush in to buy Nvidia or Microsoft because you saw a bullish segment on the news, The algorithm wakes up. It sees your demand, it sees your liquidity, and it feeds you stock. It matches your buy order with a sell order from its hidden inventory. You think you are buying from the market, but you are actually buying directly from the institutional inventory that is trying to escape. You are the liquidity. You are the exit strategy. This creates a phenomenon known as the liquidity mirage. This is why the market has been moving sideways or grinding slowly upward, despite the massive outflow of capital. In technical analysis, we call this the distribution phase. It is the phase where the smart money hands over their positions to the dumb money. The price action is engineered to look boring. It is engineered to look safe. The market makers who facilitate these trades are incentivized to keep the price within a tight range. If the price drops too fast, the retail buyers will get scared and stop buying. If the buyers stop buying, the algorithm cannot unload its inventory. So the market makers use their high-frequency trading bots to prop up the price. They place artificial buy walls just below the current price to give you the illusion of support. They make you feel like there is a safety net. But that net is not there to catch you. It is there to hold the floor steady so the whale can finish unloading the truck. Every time the price tries to rally, the algorithm sells into the strength capping the upside. Every time the price dips, the algorithm pauses, allowing retail to buy the dip and push it back up. It is a perfect mechanical siphon, transferring wealth from your 401k to their cash reserves. But we have to look deeper into the machine to understand the urgency. Why is the algorithm running at maximum speed right now? Why not spread this sale out over 5 years? Why clear the books in a single quarter? The answer lies in the bond market mechanics, specifically a structural event known as the debt wall. This is not a theory. It is a mathematical certainty on the corporate balance sheets. Back in 2020 and 2021, when the Federal Reserve pinned interest rates to near zero, corporations went on a borrowing binge. They issued trillions of dollars in corporate bonds to buy back their own stock and inflate their earnings. It was free money, but corporate bonds have maturity dates. They do not last forever. And the largest tranche of this zero-interest debt is scheduled to mature in March 2026. This creates a mechanical point of failure. When these bonds mature, the companies have to pay back the principal, but they don't have the cash, so they have to refinance. They have to issue new debt to pay off the old debt. But here's the problem. They are not refinancing at 0% anymore. They are refinancing at 5% or 6%, or for the riskier companies, 9%. This triples their interest expense overnight. There is a vast layer of the S&P 500 known as zombie companies. These are firms that do not generate enough profit to cover their debt interest. They have only survived because debt was cheap. When the rate resets in March 2026, the math of their existence breaks. They will face immediate insolvency. They will be forced to fire workers, sell assets, or declare bankruptcy. BlackRock and Vanguard are not guessing about this. They own the debt. They see the maturity schedules. They know exactly which companies are going to hit the wall, and they know exactly when impact will occur. They are running the numbers, and the conclusion is binary. The equity value of these companies is currently priced for perfection, but their balance sheets are ticking time bombs. The algorithm is selling now because liquidity is still available. In financial logistics, you must exit the building while the door is still open. Once the first domino of the debt wall falls, credit markets will freeze. Banks will stop lending. The dark pools will dry up. And at that point, it doesn't matter how much stock you want to sell, because there will be zero bids on the other side. This system is currently operating on the inertia of the past, but it is racing toward a brick wall of simple arithmetic. The machinery of the market is currently designed to hide this reality from you until the transfer of assets is complete. They are swapping their paper promises for your hard-earned cash before the interest rate gravity turns back on. This entire operation, this silent heist, relies on one critical assumption. It relies on you not looking at the raw data. It relies on you trusting the price on the screen rather than the mechanics of the engine room. But the engine room is leaking oil, and the pressure gauges are redlining. We have established the mechanism of the exit, and we have established the deadline that is driving it. But you should not just take my word for it based on the logic of market structure. You need to see the fingerprints yourself. You need to see the one chart that proves the smart money has already positioned themselves for the crash while telling you to buy the peak. There is a specific indicator used by institutional traders to track this dark activity. And right now, it is flashing a signal we haven't seen since the eve of the 2020 collapse. If we are going to treat the market like a machine, then we need to stop looking at the shiny exterior bodywork and start reading the diagnostic sensors attached to the engine block. The most critical sensor we have, the one that measures the actual internal pressure of the system, is the Dark Index, or DIX. This is not a standard indicator you find on a free trading app. The DIX measures the ratio of short volume executing in the dark pools relative to the total volume. It is essentially a fear gauge for the institutional class. When the DIX is high, it means the smart money is buying quietly to support the price. When the DIX is low, it means they are stepping away. They are removing the support beams. Look at the structural divergence on this chart. The top line is the S&P 500 price climbing higher and higher. The bottom line is the DIX. It has collapsed to levels we have not seen since February 2020, right before the pandemic crash. This is a mechanical contradiction. You cannot have a structurally sound building where the roof is getting heavier while the foundation is disintegrating. In engineering terms, this is catastrophic material fatigue. The price is rising only because there is no selling pressure on the lit exchanges yet, but the internal support is gone. The institutions are not shorting the market aggressively. They are simply refusing to bid. They have turned off their buying algorithms. This leaves the market in a state of free suspension, held up only by retail optimism and momentum chasing. When the DIX flatlines like this, it tells us that the liquidity providers, the mechanics who keep the gears turning, have left the factory floor. They know the machine is overheating, and they are standing back to let it seize up. This brings us to the operator of the biggest capital engine in history, Warren Buffett. You have to look at Berkshire Hathaway not as a company, but as a massive liquidity reservoir. Right now, that reservoir is filled to the brim with over $200 billion in cash and short-term treasuries. This is an unprecedented amount of dry powder. The media will tell you that Buffett is just being conservative, or that he is too old to understand the new tech paradigm. That is a dangerous misinterpretation of the data. Buffett is a value mechanic. He understands the relationship between price and utility better than anyone. Holding cash in an inflationary environment is painful. It guarantees a loss of purchasing power every single day. The fact that he is willing to take that guaranteed loss tells you everything you need to know about his assessment of the stock market. He is calculating that the coming crash will be so severe that buying assets at a 50% discount later is worth losing 5% to inflation now. He is not sitting on the sidelines. He is effectively shorting the entire U.S. economy by refusing to participate in it at these valuations. He is betting against the structural integrity of the bubble. I want to pause here because this is a critical junction in our investigation, and I want to force you to confront the reality of this wager. You are currently looking at two opposing signals. On one side, you have the flashing green lights of the AI rally and the promise of endless growth. On the other side, you have the most successful investor in history sitting on a mountain of cash, preparing for a depression. This is a binary choice. You cannot believe both. So I want you to go down to the comments right now and pick a side. Are you Team Market believing that this time is different and technology justifies the price? Or are you Team Cash believing that the math always wins in the end? Don't give me a maybe. Tell me if you are buying the hype or buying the bunker, and tell me why. I will be reading the logic of the first 500 comments personally to see where the sentiment of this tribe really lies. Now let's look at the accelerant that will turn this structural weakness into a collapse. In financial mechanics, we call this the gamma exposure. The market is currently held together by the options market. Market makers, those entities that facilitate your trades, have to hedge their positions. When you buy a call option, betting, the market will go up. The market maker sells it to you. To protect themselves, they have to buy the underlying stock. This creates a feedback loop where buying begets more buying. It is a self-reinforcing hydraulic lift pushing prices up. But this mechanism works in reverse, and it works much faster on the way down. We are entering a zone of negative gamma. This is where the hydraulics fail. If a catalyst hits the market and prices start to drop, the market makers are mathematically forced to sell stock to hedge their books. They don't have a choice. Their algorithms automatically hit the sell button to stay neutral. As they sell, the price drops further. As the price drops further, they have to sell even more. This is the domino effect. It removes the human element of fear and replaces it with the cold, algorithmic necessity of risk management. The liquidity vacuum we identified in the dark pools means there are no buyers to absorb this selling. So you have a scenario where the exit door is welded shut by the Iceberg Orders and the room is filling up with the smoke of negative gamma. The volatility that has been suppressed for the last year is like a coiled spring. The tighter you compress it, the more violent the release will be. The mechanics of the market are primed for a dislocation event that will make 2008 look like a controlled demolition. But a machine doesn't just break on its own. It usually requires an external shock to shatter the casing. We have identified the internal fractures. We know the gears are stripped. We know the lubricant is gone. But what is the hammer that is going to strike this fragile engine? To find that, we have to look outside of Wall Street. We have to look at the geopolitical chessboard, where a coordinate attack on the US dollar is already underway. The liquidity crisis inside the US is not an accident. It is being weaponized by adversaries who know exactly when the debt wall is vulnerable. The breakdown of the financial system is inextricably linked to a much larger game being played for the control of global resources. You need to understand that capital does not just vanish. It migrates. When we see $180 billion exit the equity market through the dark pools, it does not simply sit in a bank account collecting dust. Cash is a melting ice cube in an inflationary environment. And Larry Fink knows this better than anyone. So we have to ask the forensic question: where's the money going? If you track the asset acquisitions of these major funds over the last 6 months, a terrifying pattern emerges. They are not buying other stocks. They are not buying bonds. They are buying the ground beneath your feet. BlackRock and Vanguard are aggressively pivoting from paper assets to hard assets. They are buying farmland. They are buying residential real estate portfolios. They are buying energy infrastructure and data centers. They are buying mining rights for copper and lithium. This is a strategic rotation from the virtual economy to the physical economy. They are selling you the paper promise of AI growth, while they buy the physical copper that makes the AI run. They are selling you the digital shares of a food delivery app, while they buy the actual farmland that grows the corn. This is the anatomy of a defensive posture in a sovereign debt crisis, which is exactly what the debt wall in 2026 represents. Financial assets like stocks and bonds can lose 80% of their real value overnight. But an acre of soil is still an acre of soil. A copper mine is still a copper mine. They are front-running the devaluation of the dollar by exchanging currency for commodities before the rest of the market realizes the currency is broken. But this internal rotation is only half of the equation. If we zoom out to the global satellite view, we see a pincer movement that creates a perfect storm for the American economy. While domestic whales like BlackRock are dumping U.S. equities, foreign whales are dumping U.S. debt. Look at the Treasury International Capital data. China has been systematically selling off its holdings of U.S. Treasury bonds. They have reduced their exposure to the lowest level in 14 years. The BRICS nations are engaging in a coordinated de-dollarization strategy. They are settling trade in yuan. They are settling trade in gold. They are refusing to recycle their trade surpluses back into American debt. For 50 years, the United States has relied on a global recycling mechanism where we print dollars to buy goods, and the world sends those dollars back to buy our debt. That cycle is broken. The pipe has been cut. This creates a liquidity void that is mathematically impossible to fill. You have BlackRock selling stocks on one side and China selling bonds on the other. Both are demanding cash. Both are draining liquidity from the system. Who is left to buy? The American consumer is tapped out. The regional banks are insolvent. There is only one buyer left in the room, the Federal Reserve. When the selling pressure hits the debt wall in March 2026 and the bond yields start to spike, the Fed will have no choice. They cannot let the U.S. government default. They cannot let the Treasury market collapse. So they will step in as the buyer of last resort. They will print money to buy the debt that China and BlackRock are selling. This is not a conspiracy theory. This is the mechanics of yield curve control. We saw it in Japan. We are seeing it now in the U.S. But here is the catch. When the Fed prints trillions of dollars to monetize the debt into a supply-constrained economy, they ignite the fuse of a second wave of inflation that will make 2022 look like a gentle breeze. This leads us to the inevitable consequence for your life and your livelihood. The economic term is stagflation, but the reality is much more painful. Stagflation is the unholy marriage of recession and inflation. It is what happens when the economy stops growing, but prices keep rising. Think about the mechanism we just described. Corporate America is facing a refinancing cliff. They will cut costs to survive. That means mass layoffs. We are already seeing this in the tech sector. The six-figure jobs are vanishing. The hiring freezes are in place. Unemployment will rise. In a normal cycle, high unemployment brings prices down because people stop spending. But this is not a normal cycle because the Fed is debasing the currency to save the sovereign debt. So you get the nightmare scenario. You lose your job, or your income stays flat. But the price of groceries continues to climb. The price of gas continues to climb. The price of rent continues to climb. This is the trap of the nominal illusion. The stock market might even stay flat in nominal terms. The S&P 500 might not show a 50% drop on the board. But if the dollar loses 30% of its purchasing power due to the Fed's money printing, your real wealth has been confiscated just as effectively as if the market had crashed. BlackRock understands this. That is why they are leaving the casino. They are cashing out their chips while they are still worth something and buying the building. They are preparing for a world where the dollar is weak and commodities are strong. The network of geopolitical pressure is tightening around the U.S. dollar, and the smart money is not waiting around to see if the politicians can fix it. They know the math. They know the debt-to-GDP ratio is past the point of no return. They are evacuating the paper-burning building, and you are still standing in the lobby arguing about which tech stock to buy. The geopolitical web has been spun, and we are currently stuck in the center of it, waiting for the spider to descend. The convergence of these forces, the internal exit of liquidity, and the external rejection of debt, leads us to a singular, unavoidable conclusion about the future of your money. 2,500 years ago, the Greek philosopher Plato described a group of prisoners chained inside a cave since childhood. Their heads were fixed, so they could only stare at the stone wall in front of them. Behind them was a fire, and between the fire and the prisoners were puppeteers holding up objects. The fire cast shadows of these objects onto the wall. To the prisoners, these shadows were the only reality they had ever known. They gave the shadows names. They predicted which shadow would come next. They celebrated when the shadows danced, and they panicked when the shadows faded. They believed that if they understood the shadows, they understood the world. Ladies and gentlemen, the stock market you are looking at today is the cave. The glowing green numbers on your screen are the shadows. The all-time high headlines on CNBC are the shadows. The belief that a soft landing has been achieved is a shadow. You have been trained to stare at the wall and interpret these flickering shapes as wealth. You have been conditioned to believe that because the line goes up, the economy is healthy. But you are not looking at the economy. You are looking at a projection. And we have to ask ourselves who is holding the torch that casts these shadows. It is the institutional giants. It is BlackRock. It is the Federal Reserve. They are the puppeteers standing behind you, manipulating the light to keep you docile while they rearrange the furniture of the world. The $180 billion that just exited the market through the dark pools is the moment the puppeteers stopped playing the game. They are putting down the puppets. They are extinguishing the fire. They are walking out of the cave. And that is why this investigation is so critical. The shadows on the wall are still dancing because the residual heat is still there, but the source of the light has moved on. We are witnessing a separation of reality. The reality of the price on your screen is diverging from the reality of the liquidity in the plumbing. The prisoners are still cheering for the bull market shadow, but the men who built the cave have already packed their bags and left. Stepping out of the cave is not a pleasant experience. Plato wrote that if a prisoner were dragged out into the sunlight, he would be blinded. He would be angry. He would want to go back to the darkness because the light is painful. That is what you are feeling right now. The data we have presented today about the dark pool selling and the debt wall is the sunlight. It burns. It is painful to accept that the game is rigged. It is painful to realize that your portfolio might be sitting on a foundation of sand. It is much more comfortable to go back to the wall and believe the soothing lie that AI will solve the debt crisis and stocks only go up. But comfort is expensive. Comfort is what costs you your retirement. The light is cruel, but the light is the only thing that allows you to see the cliff edge before you walk off it. So what is the strategy for survival in a world of shadows? It is simple, but it requires discipline. Do not try to outsmart the shadow. Do not try to pick up pennies in front of the steamroller. The retail investor loses because he thinks he can trade the noise better than the algorithm. You cannot. The only winning move is to align yourself with the architects of the cave. Watch where they are going. We established that they are moving into hard assets. They are moving into land. They are moving into gold. They are holding record levels of cash. They are positioning themselves for a reset of the system. You must do the same. This is not the time for speculation. This is the time for preservation. If Warren Buffett is holding $200 billion in cash because he cannot find value in this market, then who are you to leverage your life savings into a tech stock trading at 50 times earnings? We are entering a period where the illusion of wealth is going to be shattered by the reality of math. The debt must be paid or defaulted on. The currency must be debased to keep the system alive. These are physical laws, not opinions. The smart money has already positioned themselves for the inevitable collision. They have left you with the shadows, while they secured the substance. They are banking on the fact that you will stay chained to the wall, mesmerized by the flashing lights, until the very moment the ceiling collapses. They are counting on your inaction. They are counting on your normalization of the abnormal. You now possess a dangerous thing. You possess the map of the exit. You know that the liquidity is a mirage. You know that the volume is fake. You know that the selling is real. The burden of this knowledge is that you can no longer claim ignorance when the bill comes due. You have seen the machinery behind the curtain. The question is no longer what the market will do next week. The question is whether you have the courage to stand up, turn around, and walk out of the cave before they seal the entrance. This channel exists for the sole purpose of dragging you into the sunlight, no matter how much it hurts. We are a small tribe of people who refuse to trade shadows. We trade truth, and the truth is a lonely business. Most of the world will continue to stare at the wall until the end. They will call you crazy for holding cash. They will call you a doomer for buying gold. Let them. Being right is better than being popular. But you do not have to walk this path alone. If you refuse to be a prisoner of the narrative any longer, then you have a responsibility to share this light. Send this investigation to the people you care about, not to scare them, but to wake them. The algorithm suppresses this kind of information because it disrupts the flow of the game. We rely on you to be the signal in the noise. Subscribe to the channel, not for entertainment, but to arm yourself for what is coming. The system is counting on your silence, but we will not give it to them. There is an old saying on Wall Street that when the tide goes out, you find out who has been swimming naked. But in 2026, the tide is not just going out naturally. It is being sucked away by industrial pumps operating in the dark. The water is receding faster than anyone thinks, and the vast majority of the market is about to be exposed. Do not let yourself be one of them when the sun comes up.